Good morning, good afternoon and good evening, Australian expats. Just while we're just waiting for a few people to come in, we'll just give everyone a couple of minutes. For those who have been following our podcast, this is the haircut that James and I were talking about last week. So yes, I was able to cut my hair myself. No, it wasn't pretty. And for those who've emailed me, no, I'm not going to turn around and show you the backside of it, because when you're trying to cut hair by yourself in a mirror, everything is backwards. So anyway, I don't look like a Rastafarian, so that's always a positive. For those who don't know, we have a podcast. We have a podcast that you can listen to on the Apple Podcast channel, and our podcast is called Aussie Expat Podcast, and we've got a series there called Expat Chats, where normally we do an episode once a week, usually at least once every second week anyway, depending how busy things are. And we sort of run through the latest topics. On the podcast is myself, my colleague James Ridley. James runs the Australian office and I run the Dubai office. So if you are into podcasts and you want to keep in touch of what the latest news is with respect to finance for the expats, certainly go and subscribe to the channel. For those who don't do podcasts, we also upload the video onto our YouTube channel as well too. So if you go to YouTube and just type in Atlas Wealth Management, you'll see our channel there and you can subscribe, and we also put quite a bit of other content on there as well too. So just getting up here now, so I think we're getting pretty close. We've actually got 492 registrants in 53 countries. So it's a great turnout tonight, or this morning, if depending on where you are. But pretty much, if you imagine, everywhere from the west coast of America all the way through to Singapore, in both the northern and southern hemispheres. So we're in some pretty remote locations as well. I think we're getting pretty close to getting on there. So we'll just wait one more minute. But yeah, certainly an interesting time it is to be broadcasting to 53 countries from my dining room table. So when they say it's unprecedented, yeah, I've never done that before in 23 years. So it's probably the most work that the dining room table has got with me at the wheel anyway. Okay, we'll probably start this off now. So I'm just going to start sharing the screen, guys. So I'll just rely on your feedback just to make sure that everything's going. Can I also say, ask if everyone can hear me or see me? I just got someone on the screen there asking they're not able to hear. Yep, thank you, William. That's fantastic. Okay, so let's start showing the screen. Okay, just got to move some real estate around here. Okay. Can everyone see that presentation that's up on the screen there now? Fantastic. Okay. Rightio, guys. So today we're running through a bit of an extension from what we did last month. Can't believe it's almost been a month or a bit over a month since we did the last one. So last month we ran, for those who weren't on this session, we ran through some of the key discussion points and the pain points for Australian expats as we go through the COVID-19 pandemic, covering off on the economy, super, currency, property and investments. And then we threw it open to a live Q&A at the end, which everyone loved. And the whole session ended up going for about 2 hours 45. So, heard the responses loud and clear. People love that Q&A. So what I'm going to do is probably less preaching on the PowerPoints and more throwing it open to questions. So while I'm talking, feel free to start putting in your questions, and we'll just go through in sequential order and start answering those for you guys. Okay, on to the next one. Okay, so nothing that we do in a public capacity is without a disclaimer, and for us it's any information that you hear tonight or today should not be construed as personal advice. As we say, just treat it as entertainment, and if you do need to dig deeper on the topics, then please seek professional advice. I will preface the conversation too with a Q&A. In the Q&A, we will discuss general information and general concepts. If people ask specific questions about them, I will try and answer it in a general way, but we can't provide specific advice. We do have to, as a regulated company, we do have to provide advice in a regulated fashion, and we need to essentially onboard a client first before we can provide that advice. So who is Atlas Wealth Management? We're the leading provider of Australian expat tax financial advice, and we've won numerous awards both domestically and internationally for this. We're classified as a tax financial advisor with the Tax Practitioners Board in Australia. We've got proud to service with clients in over 30 countries, and all of our advisors are degree qualified with numerous postgraduate certifications. Atlas Wealth Management in Australia is a holder of an Australian Financial Services Licence, and Atlas Wealth Management in Dubai is a subsidiary of Australia and is regulated by the Dubai Financial Services Authority. Okay, who's these two ugly roosters? Obviously me on the left and my colleague James Ridley on the right. James runs the Australian office and he's the Managing Director for the Asia Pacific region. So virtually everyone from Singapore through the United States, he looks after that region, and then I look after from Singapore west through to London. James and I normally co-share on these sort of webinars, but as it's 1:30 in the morning his time, I thought it better for him to have his sleep and me to run with this. Normally with these sort of scenarios, we will have certain topics that James will go into more detail than myself, especially with respect to the United States. But we'll pretty much cover off most of those things tonight, and then certainly ask any questions in the questions box if you have any. Okay, so topics on today. You'll see these topics are virtually the same topics we discussed in the last seminar or webinar last month, but we're just providing further updates on where we are at in the stage, because as you'd imagine, things are changing quickly and data takes some time to come up. So in last month's webinar, we were sort of hypothesizing a lot of issues, whereas tonight or today, we'll actually be talking about real data and what the flow-on effects are. So number one off the rank is economy. So we're starting to get some data out of Australia, and the ATO has been using their Simple Touch payroll and to give everyone a bit of an understanding of Australian, the way the ATO works now. Everything's pretty much digital driven. Everything pretty much comes straight in from your accounting software straight to them. So they've almost got real-time reporting, and according to the ATO, 2/3 of Australian businesses reported that their turnover or cash flow has reduced as a result of COVID-19. I don't think there's any surprises there. The humbling thing is the fact that 1/3 is still okay, which is great to see. Nearly half of those businesses have made changes to the workforce arrangements as a result of COVID-19. You might remember in the last webinar we talked about particular sectors are more prone to problems than others, and over the next couple of slides I'll sort of run through which sectors are the ones that are doing okay and which ones are experiencing problems. So what we're looking at here is essentially the business workforce changes, and these are companies reporting their changes to their staffing, which I found quite insightful. So essentially 0 to 19 persons, that's a small business, and it breaks it down there based on the different effects that staffing is having due to COVID-19. I'm not going to refer to colours because I'm colourblind, because I will make everyone laugh if I start reciting colours. So I'll refer to the first, second, third and fourth and fifth ones. Obviously the first colour is temporarily reduced staff work hours. Second one, staff placed on paid leave. Third one, staff placed on unpaid leave, including staff that have been stood down. The fourth one is the temporary increased staff work hours, and the fifth one is hired additional employees. So if you look there, it's actually quite good to see that, for me, even from the small to the largest of businesses, they're still writing things out. If you do look at the small businesses, we see that they're probably the lowest one when it comes to the temporarily increased staff work hours. That's pretty much a function of small businesses. What we find is, the owners or the managers tend to step in to try and pick up the load there. But what I do, like seeing is actually that last one there, which is hiring additional employees. So as we can see here, in all categories, particularly the 200 or more persons, they're actually hiring more staff. Now, obviously, this is a combination of all different sectors. So if everyone's wondering why in one chart they're saying that temporarily increased staff work hours, another one saying they're placed on paid leave, that's because some sectors are hiring and some sectors are letting staff go. This next one here is quite a good one to see, and we touched on this back in March. And I think anyone who's stuck at home in Dubai here, we're under 24-hour lockdown, and certainly the wallet hasn't taken a break from a lot of people. So whether it's buying your groceries online, whether it's using Amazon, whether it's using any sort of e-commerce site, this is just March's figures, which is quite impressive. And this is the percentage change on an annualized basis adjusted seasonally. So if you go back and look at where they were this time last year, they're actually retail sales just for March alone was up 8%. Talking to clients who work in the logistics game, these companies work with a lot of the major retailers. They're talking some pretty big numbers that are going through their trucks. So it's going to be interesting to see what happens over the coming weeks and months with respect to a lot of those retail areas. But certainly retail that has been able to pivot and leverage upon people's four-wall cells is certainly doing very well. So I just want to come through and start to throw out some numbers on unemployment. The issue with unemployment right now is the numbers always tend to be a bit slow. So you might remember in the last session we talked about the average, the unemployment rate back in March was 5.2%. Obviously, it takes a month for that number to change. But what we've seen over the last week is the Australian Bureau of Stats has realised, and I guess this is from pressure from the government, is that everyone's trying to make policy changes on a daily and weekly basis, and they can't wait for those numbers to start to come through. So what we're starting to see is they're going to start taking a leaf out of the US book, and they're going to start releasing weekly jobless numbers as opposed to just combining it all into one big report, which will be released in the following months. So right now in April, we won't see April's numbers until May. But at the moment, certainly with the way things are going and the speed it's going, May feels like forever away, and we need to get this data coming through. According to the ABS, at least 540,000 people have lost their jobs in less than a month because of the COVID-19. Between the 14th of March and the 4th of April, so that's the 3 weeks after Australia recorded its 100th confirmed COVID-19 case, jobs decreased by 6%. The largest impact was for those under 20, and obviously they're probably the discretionary employees of businesses, and for them jobs decreased by 9.9%. Accommodation and food services industry saw the largest reduction in jobs, down by 25.6%, followed by the arts and recreation services industry. And in this next chart over the page here, we sort of run through some of the sectors. Interesting to see up there, number 3 was actually mining. And talking to some clients who are in the resource game, the primary reason for that was actually those bigger miners like the BHP and Rios were able to get staff in and on site and able to get a number of shifts in that capacity, so that they didn't have to suffer any downturn or any shortage of being able to produce. Whereas some of the medium and small mining companies didn't have that luxury or flexibility, and as a result, they don't have the crews to be able to mine, and that's why we've seen a reduction there. No surprises in the rental, hiring, and real estate services. When you consider whether it's holiday accommodation or Airbnb, obviously no one is travelling, so there's no surprises there. Professional, scientific, and technical services. That's actually more so in the medical areas and those sort of things, which is quite surprising at 7.9%. Talking to a client the other day who's an anesthesiologist, his income is down 90%, 90%. And the reason for that is obviously he drives the bulk of his revenue from elective surgeries. And now with elective surgeries being placed on hold indefinitely, he's essentially taking a massive pay cut. And what we're seeing out of COVID-19 is it's almost indiscriminate as to your background, your educational qualifications. It's hitting people in the most far-reaching ways. And the more people we talk to, I was talking to a gentleman the other day, he's the first officer with Qantas. He just moved back to Australia in the last 12 months, and right now he's packing shelves. So, we're seeing a lot of people who, really have had to pivot. I don't like using that word. I think it's thrown around too much by the tech community, but they've had to pivot, and they've actually had to put steps in place to ensure the income keeps coming through. So the next one we want to go on is currency, and I won't go too far into this because right now it is like throwing a dart at a moving train. But just this chart to me does provide a lot of insight. And essentially what this chart is virtually the Australian dollar going back into December last year. And as we saw building up to March, Australia was on a downward slope. And those two lines there that I've drawn, what they are is essentially this one here and this one here. These are called trend lines. And what will often happen is when either a currency or a commodity or a stock is trading in a trend line, it does build momentum. People do look at these sort of things to get an idea and gauge the direction it's going in. You will see issues from time to time whereby we see these breakouts, and that's what I'm sort of put those arrows in there, where you see this slight breakout and then it retraces back into that period. Obviously this second one here, we saw the support levels absolutely smashed, and that was obviously driven by the rush to US dollars that we saw just recently. Over the last month we've seen a recovery in the Australian dollar, but it has run out of steam, and right now Australia is still, or the Australian dollar is still considered a relatively high risk currency as opposed to holding yen, US dollars or euros. So as you can see here right now, it is still following that downward trend down. We may see breakouts, and I will always caution anytime we look at this, it is not a guarantee that it has further to go. That trend line can be broken and a new trend line going up can be set. But I just found it was quite an interesting, from a visual point of view, to see that there is a pattern emerging here of where the dollar's going. And obviously the high probability further downside could exist. Obviously what's going to cause further downside will be a myriad of things. Certainly bad data coming out of Australia, bad global data around the world. If we do see that risk-off pattern that we saw back in mid-March when the dollar got down to the 50s, people could rush back into US dollars. There was a big shortage of US dollars at that time. Since then, the US Feds have begun to print cash endlessly by way of their QE Infinity package, but certainly people will vote with their feet if they do get nervous, and there is always that flight back to US dollars. Just wanted to quickly touch on tax residency, not that there's anything to update with, but we've been checking the ATO updates on a daily basis and we haven't seen anything yet. Back in March, they did indicate that they understand that there are people who are classified as a non-resident for tax purposes who are stuck in Australia. And what they've said was, as long as you intend to return back to Australia, once the border closures are lifted, then they will not seek to classify you as a resident for tax purposes. However, in saying that, they did sort of provide a bit of a time frame to that in terms of April and May. We'll have to obviously watch the further updates over the coming weeks, and encourage everyone to sort of follow our website as well as our social media channels, because as soon as we see an update there, we'll certainly let everyone know. But for the time being, there's still nothing to report, which I guess is a good thing, but watch this space, because we obviously want to see if borders remain closed, especially after 30 June or even into the new financial year, how the ATO is going to classify that. So jumping on now to superannuation, and I sort of felt a bit bad with our last webinar, because obviously we had a bit of a swipe at Host Plus a couple of the other super funds, and then next week out it comes that they really do have quite high liquidity issues, and it did cause a lot of concern out there. We received quite a large number of emails from people who do have Host Plus, trying to work out whether they should panic or what they should do with these sort of things. But what we're going to run through is, certainly the first topic will be the early access to super. As we indicated recently, you must satisfy any one of the requirements to access early super. We've crawled through the explanatory memorandum and all the legislation. There is nothing in there precluding an Australian expat who is classified as a non-resident for tax purposes to get access to that money. But we will say that the ATO is wholly responsible for identifying and verifying the hardship. At the moment, we've seen, not from our clients, but from colleagues, that they are processing these things in a matter of minutes to hours, so they are quick. But The ATO has warned that will review all applications, and anyone caught fraudulently accessing their super will be slapped with penalties up to $12,500. You know, I put in there, remember these three letters, CRS. And the reason I put that in there is if you're in Hong Kong, Dubai, London, America, and you are going to try and claim up to $10,000 in this financial year and $10,000 next financial year, make sure you have a reasonable basis for doing that. Don't just do it because you always want to get some money out of super and here's your chance. And the reason being is the Common Reporting Standard is a global initiative between 146 countries and territories, and that is the sharing of data. So right now, if you are an Australian expat in London, for example, HMRC is sharing your bank data with the ATO. The ATO already knows how much you earn and everything off all that data that the banks have been providing to the HMRC. If they really want to go through and do some revenue raising, they more than likely, they could go through all this data, and if you can't substantiate that you are unemployed because of COVID-19 and they still see income coming through, then you may have an issue. So really be careful, guys and girls, because it's not a free-for-all. There will be significant penalties coming through if you don't do it accordingly. Okay, so running on now to concerns regarding super. And look, with this one here, it was a bit of a two-edged sword. Obviously, us highlighting our concerns regarding the industry super funds, they still stand. You know, you're going to see certain funds affected more than others. As I was preparing the presentation today, Super Ratings, which is a independent rating agency that rates all the super funds in Australia, they actually came out and said that 15 funds are on their watch list with respect to liquidity issues. So, you know, just keep your ear to the ground, guys and girls. With respect to this, we don't think this is out by any means. We could see a bit of a perpetuating snowball going on from here. And the reason we say that is if you've got a larger run than the industry funds have banked on in terms of having available cash, then they're going to have to sell more stock in the market because they can't sell their unlisted assets. And what's going to happen is that could cause the market to pull back further. So right now, it's only new. It was only open on the 20th of April, and obviously we're at the 23rd of April right now. So over the next couple of days, we should get a bit of data. There are talks of up to 1 million people who are looking to access their super, and it's certainly going to put a lot of pressure on the industry funds as well too. After our comments last month, the week after, Host Plus came out and they introduced a redemption freeze verbiage in their paperwork, which is concerning. So virtually what it means is if you go and want to either go to cash or transfer out, they do have the right to be able to freeze that redemption and not allowed to go through. So it is concerning. The other thing concerned us was the industry super funds approach to the RBA and APRA for a liquidity lifeline, and they were knocked back, and I still think rightly so by that. The reason why they wanted that lifeline is because obviously if everyone's pulling money out of their funds, then they have to sell stock to fund those cash redemptions. Obviously, if they're going to have to sell when the market's low, that's a nature of the market. Whereas what they wanted almost like a credit facility with the RBA, where instead of selling stock low, they could actually draw money out, and then as the market recovered back up, they could pull it back in again. So from our point of view, it's not the way a normal market functions. There is a serious breach at the trustee level with the industry funds, and I think you will see more play out with respect to this. Okay, on to the topic of property. I'm almost sick of talking about it, but main residence exemption, this is pretty much us at the moment. We are shaking every tree. We are contacting everyone on our Rolodex. We're trying to do everything we can do right now to get Canberra to try and announce an extension to that 30 June period. We haven't given up. We've got to keep going with this. We've got to keep going until 30 June. Not that it makes a difference if it's a week out, but we're hearing some horrific stories from clients and expats at large who are trying to deal with this. We've got situations where if a tenant is essentially, runs out of money and they highlight that to you, then by all means you have to actually extend your lease. You can't evict them because there's a ban on evictions. So, we've got clients who are trying to sell their properties and they're stuck with tenants. So clearly, with the way things are going right now, it is not sustainable. When the main rents exemption changes were received royal assent back on the 12th of December last year, they afforded at least a 6-month period, a transition period for Australian expats to be able to make their changes to their financial circumstances. If you take out December and January because of the Christmas and New Year holiday, they've pretty much only had 2 months, and now the doors have shut, and to us it's unacceptable, and we'll keep everyone updated on what's going on there. Okay, on the pricing updates, right now pricing is very hard to come by, and the reason being is we've seen a dramatic drop in pretty much all transactions on the property market, and the reason for that is obviously the stage 2 restrictions with respect to bans on open houses and auctions. So looking at data that Domain have provided, they've showed a significant increase in the proportion of homeowners who are on the market, who are dropping their prices. In Sydney, and this is just back in March, in Sydney 14% of vendors lowered their asking price in March compared with just 5% in late 2019, and in Melbourne asking prices were cut 12%, 12.6% of listings in March. That's not a 12% fall, that's a 12% cut, so we don't know what that figure looks like. From the information we're getting from clients who are trying to do off-market sales to try and get these properties sold through the before the 30th of June with the main residence changes, we are hearing some drops of anywhere between 5 and 20%, all depending on what market they're in and how motivated the seller and also the buyer is as well too. So to me, we're not going to get a true clear picture until that 6-month moratorium on evictions is up, or also too we start to see open houses and auctions able to be conducted again, because that is obviously the real market, real timing. We can benchmark what this property is worth if a similar property sells for that price. To me, it is going to be some carnage. You're going to have probably 3 different sellers in there. The first seller is going to be obviously someone who is an owner-occupier who's lost their job. Yes, they've got a 6-month grace period from the banks, but to me, do they have a job to go back to after that period and point? And we've got some more data coming up which just shows how on the edge people have been living going through all of this. So the second person who is selling will be certainly the investment property owners. If they're not getting any rental yield in, they're going to try and get rid of these things if they can't afford to substantiate or sustain that property as well. And the third one will certainly be after that 6-month period's gone through, it'll be those banks taking mortgagee in possession. So this is quite a nice chart we see from the ABS, and on the left-hand side here we see housing prices coming back. Bearing in mind this is obviously into the period of February and March, so we haven't got updated figures on that just yet. But as we can see, house prices are coming back, household debt has not come back at all. So the real question is going to be is high LVRs, negative equity, those sort of considerations, and we're not going to see that truly play out. We're not going to get a true picture probably till July and August and what's going on there. This is an index provided by ANZ and Roy Morgan, and what they do is they survey households and they ask them to compare their financial position compared to a year ago. And as you can see here, quite stark numbers in terms of where they are right now, down in the 70 range, where normally they're up in the 110, 115, lower than we were back in the GFC as well too. So households by and large in an aggregated fashion aren't doing too well. There are some households doing better than others. It's always that one I mentioned in the last webinar, and my clients always hear me talk about. Averages are dangerous, but by and large you can sort of see that the average Australian household isn't doing it too well at the moment. This is a good chart or table here as well too, and even though the data is back to 2018, while times were good, it does give you a better idea as to where things are with respect to people's capacity and ability to survive these sort of pullbacks. So what we've got here is the liquidity buffers. How much can they afford for what period of time without any income coming through the door? So the first column there, you've got outright owner occupiers. From their point of view, they don't have any debt. So as you'd expect, they do have the ability in terms of being able to support themselves, but surprisingly not by that long a period. The next one is indebted owner-occupiers. Obviously those people who live in their own house, and from their point of view, 20% you're looking at they've got less than a month, and about 15% 1 to 3 months, and about 10% you're looking at 3 to 6 months. Renters, this is the one that's concerning, because obviously there is a large property market out there who they aren't liquid. There's a lot of people who own investment properties who have 3 or 4 of them, and they rely upon the tenants to be able to pay their rent in order for that investment property owner to be able to substantiate and pay for their mortgages. And as you can see here, not many actually have greater than 1 month of salary or of money available. So it is concerning. That fourth column over, we're looking at the employed versus the underemployed and the unemployed. So it really just gives you an idea that, like we've been saying for many years, Australians have been living too close to the edge. And unfortunately, I think the what we're going through right now is going to push quite a few into some desperate situations. A client of ours asked us to do a bit of research on landlord insurance, and we're able to come up with the following information. So at the moment there's probably 3 main players in the landlord insurance sector. There's ANZ, EBM Insurance and Terry Shear, and what is concerning is the verbiage coming out of these insurers in terms of what you can and can't do as a landlord. ANZ is restricting landlord insurance to existing or new customers who are applying for a loan. So virtually rules out customers with existing investment loans and customers with no home lending with ANZ or non-ANZ customers. EBM Insurance, they've stopped offering new landlord insurance cover. It's also advising existing clients that they cannot claim insurance to cover the shortfall from agreeing to reduce or suspend rents unless the tenant defaults or does not catch up on payments. So if you and your tenant agree, which is what the government wants you to do, to suspend or reduce your payments, you cannot claim that difference back on your insurance. Terry Shear has done something very similar as well, that no cover if a tenant remains in the property and does not pay rent. So an eviction has to occur in order for you to have a claim on that insurance, and obviously as we know that there's no evictions possible. So our section last month on investing was very well received. We've got a lot of aftermarket inquiries and questions on the back of that. So I thought I'd just come through and sort of paint a picture of how corporate Australia is going. Obviously we see 2 very different things playing out in terms of the ASX versus property versus the foreign markets. And it's important to have a look at how corporate Australia is going, because believe it or not, they're actually not doing too badly. Even though the share prices have been beaten, they're not doing too badly at all. So here we're looking at listed corporations' debt at risk. So if you look back in 2008, you're looking at just north of $150 billion of debt at risk. Hell of a lot of money. At the moment, we're looking at probably around 60 billion. So even though we're in a situation that is evolving and that number may change, what we're seeing right now is corporate Australia, and primarily thanks to the GFC, are a lot better positioned than they were back in 2007 to get through these sort of crises. In the next slide, I'll run through some of those sectors that are highly geared versus lowly geared. And what we're always talking about is when you go to invest in the market, it's not a matter of just taking a shotgun and buying everything. That's not a very good strategy, because you can't control your risk. And obviously, you wouldn't be buying Qantas or Flight Centre or those sort of stocks right now based on the problems they're going through. So here we're looking at business liquidity and gearing ratios. And surprise, surprise, on the left, you have the accommodation sector, which is at the highest, then arts, then transport, and it comes all the way down to the mining sector. And then you got liquidity, and surprise, surprise, with the boom that the miners have been having, they've got the highest liquidity. The concerning one is obviously accommodation. They've got the lowest amount of liquidity and the highest debt. So those guys are going to feel the brunt of it. So is art, so is transport. Healthcare to us, we're not too worried about, because as long as their services are in demand at the moment, they should be able to ride through these sort of scenarios. Real estate services, depending on their specialities, that will do okay. Reading an article just recently, and they were saying that for those people who want to actually go out and, from an investment property point of view, looking at pay down schedules or asset, mine's gone blank here. Yeah, I'll come back to it in a sec. So, there are sectors of each sector that are doing okay. But when it comes to, if you are looking to invest, you need to go through and not pick the eyes out of everything, because certainly, are you going to go through 3,000 companies on the ASX? You're probably not. But go through and look at sectors that are riding this out okay. But also, once things get back on the mend, they're not going to suddenly fall off the perch. They've got, got to continue to pick up on the back side of it. So, just do your homework if you are looking at coming into the market, and just ask yourself, when it comes to investing, there is a lot of, really clean, transparent data that you can go through, and you sort of look at how you're living right now, and you go through and look at these sort of scenarios and say, well, I'm still using Amazon. Maybe Amazon's worth consideration. So all these sort of things come into it, and to us, we're always looking at companies that are going to survive and thrive in the now and going through the next section. So what we thought we'd do here, because there's a lot of conjecture about has the market taken the brunt of it, and for those who survived the GFC, including myself, this market right now reminds me of the GFC to a certain extent. So you can see here, can anyone see my mouse? I'm just putting up on the screen there. Can everyone see that? Try again. Okay, great. So what we're looking at here right now is I've placed 4 arrows, and this here is a period that was back in October 2007, and consider that the current day equivalent to February this year. We saw a 38% drop down here into March of 2008, and the market said, okay, great, we've gone through the worst of it, it's priced in. Then we saw a rally of about 17%, and that was up into early May, and then down it came, and that fall was about 44%. I don't think we are going to see that second lot fall of 44%. It may just go back to our recent lows. So what we're looking at the moment is, if I go to the next chart, you can see a very similar pattern emerging here. So as you can see here, we've got the peaks back in February, and then we see that fall down into March, and then we've seen that recent rally. So the fall was about 33%, and then the rally's been about 25%. So where we are right now is we saw that peak it out, and we're seeing the market sort of drifting back now. The markets thrive and require oxygen, and that oxygen is always good news, stimulus data, a vaccine, those sort of catalysts that kick things on. The longer that we go without that, then that doubt comes into investors' mind. Remember, investing, whether it's in shares, commodities, property, doesn't matter what it is, 70% is psychology. Do you feel confident to buy? If you and all your colleagues are in the same situation, that is going to push a market up. As opposed to if everyone's starting to get nervous again and they see the headlines on the CNBC and CNN, and that doubt starts to build, that's when you see things start to come off. Right now we are going into what we call the confession season. So Australian companies will report their results at 30 June and deliver those results in July and August and September. In the build-up to that, companies have the ability to update investors just before they deliver those results in July to say, hey, guess what? You know how we said we're going to deliver 10% earnings per share growth? You know what? It's not going to be that. It's going to be a 20% fall. So we are going to start to see, as companies find out more data, we're going to start to see this starting to play out, and they're going to start to update the market, and the market's going to react accordingly. Some companies actually may provide earnings improvements, which would be fantastic. But from our point of view, and what we're seeing right now is, we're in a bit of a news vacuum, which is always that dangerous period. And that's why I think what we're going to see is this market here is going to start to drift back and come a bit further down. So watch that space, because certainly we think that's going to be an opportunity. We received a lot of questions from people saying they're getting into the market for the first time. How do they play this? Now, like we said in our last webinar, we don't, no one rings a bell when we go through the bottom. The bottom of the market is historical. And what that means is it's almost impossible to perfectly time the bottom of the market. if you do time it, it's more luck than anything, but you would never know it's the bottom until days, weeks, months later on. So the best way to play this market is, if you are looking to come in for the first time, work out what you're going to buy, make sure everything's sound, monitor those holdings, and then start to come in and start to drip feed money in using a dollar cost averaging approach. So what you want to do is almost like buy in a J period. So as it's coming down, you buy. You'll keep buying because you don't know it's at the bottom, and then things will start to bounce up on the other side. And if you're putting in 10, 15% at a go on the way through, you'll look back in 6, 12 months' time and go, wow, I was a genius. But all you're doing is just taking advantage of A, a falling market, and B, dollar cost averaging. You'll get a nice average price. Obviously, if things start to accelerate in terms on the downside, the news gets horrendously worse, you just pull back. But the biggest risk you have as a first-time investor is not being in the market. And the reason for that is when we see that turn on the other side, if you look at the returns 5 years after a correction like we're going through right now, after 5 years, 20% of that return over that 5-year period is in the first 1 to 3 months. So you cannot miss that turn, because when it happens very quickly. And there's a lot of things that could be a catalyst for that turn. It could be a Roche or a Pfizer or someone like that coming out with a treatment. Or I don't think we'll see a vaccine until 2021, but you never know. Some of the smartest brains in the world are working this right now. There's all sorts of catalysts that could turn this market around. And what you don't want to be doing is sitting on the sidelines, trying to chase that price lower and lower. If you are looking at companies that are sound and are doing okay, and the lights haven't been turned out, go back and look at the price back in February. If it's 20 or 30% off, it probably is good value. Yes, their earnings might have fallen by 10%, but that doesn't justify a 30% fall. As we go through the July and August period, what we're going to see is companies starting to report their 30 June numbers. And that's when they take the covers off and we see what's really going on in corporate Australia. But the market, if they can, will not wait for that period to react. If they know, based on data from the government or somewhere, all these things are occurring, they'll anticipate what's going on. So you might have heard the saying out there, buy the rumor, sell the fact. And what that means is, you might have seen before, a company can issue a $2 billion loss and it goes up 10%. And people say, how is that possible? And how it's possible is because the market was expecting them to lose 10 billion. So, there's always that relief rally on the other side. And certainly in markets like this right now, the market is generally an optimistic beast and it wants to go up, and investors want to invest because that's why they're in the market. So sometimes they will grab onto something very flimsy, like we've seen recently, and it goes back up. And other times there's be some big nuggets of information that come through, real strong, hard economic data, that people can then price out, okay, we know that the coronavirus has had this effect on the Australian economy, but the way the market's trading, it's like double. So therefore we know there's more upside there. So these sort of things from a psychological point of view, when you are investing, you are going to want to invest when the market is rising, because, that's the way our brains are wired. Our brains aren't wired to jump into the market when it's falling. But just go through, run your numbers, make sure the companies are sound. There's a plethora of information out there on the internet where you can do some basic research and look at companies' gearing ratio, look at their earnings, look at their cash flows, look how much liquidity they got. This is all open information, and then just go through and just pick companies that that appeals to you, and go from there. Just before I wrap up and go on to the Q&A too, we received a lot of questions from people who have CommSec accounts. So I apologise to the CommSec people there, because I think by the sounds of it, they got a rush of calls and emails from expats. But just to explain that once again, if you are using an Australian address, make sure that it is classified as a non-resident account. CommSec are telling everyone that they've spoken to us that they can't do that. We can certainly assist and help, and don't hesitate to reach out, but do not kick the can down the road. I was talking to a gentleman a week after our last webinar, and he had a CommSec account with a reasonable amount of money in it, going to his mum and dad's address. So therefore, he didn't have a non-resident withholding tax coming out. he had to go back and file 5 years worth of returns when normally he wouldn't have had to declare all this dividend income. So not only did he have to pay for 5 tax returns, but he also had to pay penalties and fines as well as interest charges on the money he owed. So, you can, from a user experience, it is easy to use CommSec, but it can cost you thousands, which it did cost this gentleman. So we'll run over now to the Q&A section. So if everyone would like to start putting their questions in, I'm just going to have a quick glass of water, so just give us 2 seconds. Okay. Okay, so let's jump onto here now. Sorry, I'm just, for some reason, it just... Okay, so running through the questions here. Okay, a question from Christopher. Due to COVID-19, I've been placed on a temporary layoff from my employer. ATO's requirements for early super withdrawal states that unemployment is the reason for qualification. Are Australian citizens living overseas, no longer Australian residents for tax purposes, able to make an early withdrawal? From Chris from Florida. Look, good question, Chris. And as you know, out of those 3 qualification questions, pretty much the only one that Australian expats can qualify under is unemployment. They're not entitled to Centrelink, and from our point of view, the early access is a problematic situation. The other issue with you being based in the US, you may or may not be aware of the issues with respect to the IRS's treatment of super. So just to give everyone a bit quick Super 101 tutorial for those in the US, the IRS does not classify Australian super as a foreign pension. It classifies it as an employee benefits trust or a foreign grantor trust. What that means is potentially any withdrawals from super, whether before or after your preservation age, is taxable by the IRS. So what that essentially means is if you do draw down super, if you're able to qualify, then be aware, because on the other side, when you do your IRS filings, you are and potentially will be hit with tax. Question here from Alessandra. I have superannuation and a pension. I don't plan to return to Perth anytime soon, so is it worth still contributing to my super or focus on building my UK pension? Thanks for your question, Ali. Look, to me, let's take a step back. We always talk about you want to accrue wealth in the country you intend to return to or retire to. If Australia is that country that you intend to return to, then we often say, because of the known knowns, to quote Donald Rumsfeld, it is often easier to accrue wealth there, as opposed to the issues we've seen with the HMRC and UK pensions since 2014. So just to give everyone a quick explanation there, up to 2014, you could have transferred your UK pension at any age back to Australia into your super fund if you were returning back to Australia. The HMRC didn't like that. Apparently 25% of UK expats were going back to Australia, and they closed the boom gate on most countries in terms of doing what they call a QROPS transfer. So, Ali, without knowing your age, the issues you've got to contend with is right now the only way you can move money from a UK pension to Australia is after the age of 55. Even then, once you get past the age of 55, you then have to set up a self-managed super fund. You have to create a very specific trust deed that relates to HMRC, and then you have to apply to HMRC to have your self-managed super fund added to the ROPS list. So as you can see, it gets quite complicated, whereas most clients tend to find it's easy just to contribute to super because then it's there waiting for you. You know, if you're in London for the next 5 years, you don't know what regulatory changes are going to occur with regards to your portability of UK pensions back to Australia. If you jump on a plane in 5 years' time, you know your super's there waiting for you. That's our general word of mouth. But certainly everyone's open to their interpretations. But if you want to try and keep things simple, and with how complex things are right now, we're always talking about those sort of scenarios as well too. Okay, so on to the next one here. Okay, Ali's is saying can't see any details. Okay, I'm not sure, Ali. Just for those online, certainly with, okay, let me just clean this up here. There's quite a few questions here. For those who can't hear and also, or maybe can't see, we're going to be actually putting these slides up and we'll email them out as part of the recording as well too. So don't be too concerned if you can't see anything there. It may be to do with your settings on your iPad or computer. Okay, on to the next one here from Amy. What happens if expats are forced back to Oz in March, but due to virus issues in their home country, they can't get back within the first 183 days? When does their residency start in Oz? Look, great question, Amy. My wife and daughters are actually in that situation themselves. So speaking from experience, certainly bachelorhood was fun for the first week, but then fast forward, 5 weeks. It's looking forward to having them back. But long story short, the ATO has said they understand the situation. Your tax residency status does not change as long as you return to your principal country of residence within a reasonable period once the border restrictions are lifted. When they made that announcement, they did sort of say for the next 2 to 3 to 4 months. They weren't very specific on that time frame, so we're expecting them to update this in the coming weeks, hopefully, and keep an eye on our social media channels for updates there, because there will certainly be more to come with that one there. But for the time being, expats are okay, but certainly keep an eye on our social media channels there. One from Lisa, lost the slideshow. Okay, Lisa, yeah, we'll certainly email out the slides as well too, so don't be too concerned. We'll be sending out a copy of the recording as well too, which I actually have the slides in the video as well too. Question from Osama. Good evening, Brett. Can you please advise regarding the super withdrawal effect, also housing and investment over WA specifically? Okay, Osama, are you referring to what the effect of super withdrawing all that super out's going to have on the market, or is it super? If it's super, some funds will feel it more than others. Countries. Super funds like REST, which is the retail industry super fund, and Host Plus, which is the hospitality. As you saw from the details in the charts, a lot of them are going to feel the brunt of those early withdrawals. A lot of the people who have money in there have low balances combined with young ages, and as you saw from the charts earlier, it is the young in that industry that are going to feel the most. So long term, you may see mergers between super funds as their funds dwindle. It's an evolving beast. It's changing it on a daily basis. So in terms of super funds, look, some funds will be fine, and other funds will be really feeling the pinch. Housing and investment over WA. Look, I think generally speaking, the housing sector requires capital to keep it going, and right now Australian banks are the shock absorbers of the economy. They're the ones wearing the 6-month mortgage repayment windows. They're the ones who are wearing the 6-month business loan exemptions as well too. At some point, they are going to need to get their money back, and if they can't get it back in an expedient manner, they're not going to be able to lend out. The other issue you've got as well too is banks right now, they're what they call the net interest margin, which is how they make their money, is at record lows. It's never been as low as it is right now, and this was even before the coronavirus hit. So banks aren't that profitable as it is. They don't have a lot of capacity to cope with a lot of defaults. The reason they've survived it so far is because after the GFC, there were a large number of changes with respect to capital requirements for the banks, and they increased those. So it certainly is helping banks as we speak right now. But long story short, when it comes to providing loans, the banks are going to be very selective in terms of who they give money. We've already seen some banks putting blocks on certain sectors where they would not provide loans at all. So without the loans, obviously property can't turn over, so there could be further weakness. Different markets, different things. Sydney is very different from Perth, which is very different from Adelaide, which is very different from Brisbane. So, without going into each city directly, I would say generally speaking, you will see a pullback with some cities more than others. Okay, question from Chris. Are there implications of early withdrawal of super if you fail to lodge with the ATO an overseas travel notification? So Chris, are you saying you haven't done a final lodgement with the ATO? If that's the case, look, and this is what I said in the the slide about early access to super. The biggest issue you got is the ATO is the gatekeeper when it comes to authorising these things. If you don't need the money, do you really want the ATO, having ready access to all the information you have to provide to substantiate possibly a legit or bogus claim? So, I know it's always tempting to grab an easy 10 grand for money that you've never been able to look at anyway, but you just need to consider those implications. It can open up a bit of a Pandora's box when it comes to those sort of issues as well too. Question from Alexander. Could you please repeat the website that ranks super funds? I'll put it on a list of the article as well. It's Super Ratings, SUPER space RATINGS. Just before everyone goes and looks, they have not released that information in terms of that list of those super funds. All they've said is 15 are there. Obviously, what they don't want to do is cause a run on those funds. What they've done is they've said there's 15 funds on this list, and they will go out and seek clarifying comments from each of these funds to either allay their fears or cause any problems. So certainly, I'll put a link in that in the email out when we send out the recording of the video. But yeah, certainly Super Ratings is the agency. Okay, question from Gemma. I understand you can take a break on your mortgage payments if your tenant stops paying rent, but can you confirm that you will still need to pay the monthly interest? AKA, if you're paying interest only, there'll be no reduction in payments. Gemma, from what we understand, it is a total holiday in terms of repayments. However, any interest that you're not paying will be capitalised. I think looking at some information, rough sort of data, by taking that 6-month break on your mortgage, it will take an extra 13 months of repayments to play catch up. So banks will certainly make more money over it because your interest cost is capitalising. But yeah, from what I understand, it's both, it's the interest component, and if you are P&I, the principal component as well too. Okay, question from George. Given the change in capital gains, what is the basis of the capital gains? Sorry, George. If we return to Australia and move back into our house as our primary residence, how long do we have to be in the house before avoiding a capital gain? Yeah, good question, George. And there's a lot of misnomers here, which is, it's good, always a good situation to be able to clear these up. So, long story short, if you have been away for less than 6 years and you move back into that house and make it your principal place of residence again, and you were to sell that property, then the main residence exemption would still apply. You do need to re-establish yourself in that property, and normally we talk with clients between 6 and 12 months, because don't forget, in order to change your residency status, you need to take into account the 183-day rule, but also too, you resettling into Australia as a tax resident, and that may be getting a job, putting the kids in school, re-entering normal day-to-day life that an Australian expat has as well too. Question from Gemma. Is there a strategy to get insurance companies to change their policies with regards to covering shortfalls in the event that you cannot evict a tenant? Look, Gemma, I think you've got Buckley's chance here, I'm afraid. The insurance companies are in the game of terms and conditions, and they like to employ a fleet of lawyers for this exact reason. And I don't think you'll get a chance to really be able to change any of that, to be honest with you. But certainly, feel free to ring around. If you do find someone, let me know, and I'll let everyone else know too. But certainly from those three that we saw, there are further complications ahead, and yeah, it's certainly a big issue. Okay, question from George. Does the 6-year rule exemption in terms of capital gains apply to non-tax residents? Yes, it does, George. It's the main residence exemption applies to both residents and non-residents. After the 1st of July this year, it no longer applies to non-residents. So the only way you can access the main residence exemption is by changing your tax status back to that of an Australian resident for tax purposes. Question from Pete. If you were an expat with no home loan left in Australia and you had a spare 100K US to send back, what would you do? Look, I mean, when personally, when we're looking at investing for clients, whether it's property shares, those sort of things. We always look at the asset that has the lowest downside risk and the highest upside potential. So what that means is potentially how much is there further to fall, and then on the recovery side, on the way up, how much gain is there on the other side. Certainly you'd say right now with respect to shares, they've fallen further, and the potential for that is to recover quicker, as opposed to property, which we will not see the true data of how big the fall is at the moment, and that fall may not really kick in until that 6-month moratorium finishes. So to me, the property game is going to be a longer term burn in terms of those numbers and trying to find that turn. Obviously Australia highly relies on net migration into the country to also support the property market, and you get to see that placed on hold for an incredibly long time. So now that you've got some players coming out of the market with fewer players in it, the property sector from our point of view is going to be a longer burn. Question from Andre. Thanks for the amazing webinar. I have a two-part question regarding non-taxable Australian real property such as shares for Aussies living in the US. When investing in Aussie shares, there is no capital gains tax payable to the ATO while in the US. Yes, that's correct. Are those same trades taxable in the US while I'm here? Or are only taxable in the US when CGT crystallised, so not taxable at all if I leave Australia before selling? Yeah, look, that's exactly right, Andre. So essentially what it means is if you, as a US resident, you bought ANZ, BHP, Telstra and Wesfarmers and held onto those, did not sell anything while you're overseas, and then moved to a country apart from the United States and then were to sell those, or depending on what that jurisdiction is, then yes, it's, from an ATO's point of view, there's no capital gains tax. It will depend on obviously the country that you sell those in, whether it's back in Australia or over in another country, but generally speaking, US, is quite punitive in those sort of things. I will also preface for those people on the call who are in the United States to avoid what we call passive foreign investment companies. So back in 1986, the IRS brought in an act where it was virtually discourage US investors, both citizens and residents, from investing in passive investment vehicles offshore. And essentially what it means is if your investment is classified as a PFIC, that essentially means that you get taxed at the top marginal tax rate in the United States, and they will then go back to the date of purchase and apply interest costs and so forth. What that boils down to everyone is if you are in the US and you bought a Vanguard ETF back in Australia, that is a passive investment company. So the way you classify whether it's PFIC or not is 75% of the earnings are earned in a passive nature, or 50% of the assets generate passive income. So an example of that is BHP is in the business of mining. It's not a passive business, they are miners. That is not a PFIC. A Vanguard and iShares, those are PFICs, Australian managed funds. All they're doing is they're investing your money in someone else. They're not actually making T-shirts or sneakers or widgets. They are investing in a passive nature. So, from that point of view, that is the extra qualification just on that question from Andre. Beware of PFICs. If you have any questions on PFICs, just jump onto our website, which I'll just put on the next page, and you can search there on what a PFIC is. Andre's second part of the question, are the same tax advantages under non-taxable Australian real property available when buying US shares or other international shares from the US, i.e. when buying non-Australian shares? Look, Andre, I'm assuming that you're saying if you are in the US and you bought shares in the US, obviously the ATO has no overview of that anyway. So from their point of view, any US shares bought as a US resident wouldn't have any bearing with the ATO at all. Looking here from Christina, can we access this recording after the session? Yep, no, definitely, Christina. We're recording it, and we'll be sending out in the next probably 24 hours a copy of that recording, so you can replay it back and listen to my great dulcet tones. Question from Nicholas here. Why would anyone use CommSec instead of a lower cost alternative like Interactive Brokers, which has the lowest brokerage fees and offers access to a great number of stock exchanges. Look, Nicholas, completely agree. IB is a beast. When I was working in portfolio management for Smith Barney Citigroup themselves actually used IB to do a lot of their clearing trades. It's for the same reason that a lot of retail mum and dad investors don't use IB, because it's not the most user-friendly when it comes to interfaces and putting trades on. It's not just a point-and-shoot sort of scenario like CommSec. So yes, IB is amazing, and for those who do have the time and inclination to learn it, it is a pretty phenomenal platform. You can virtually trade 42 markets simultaneously if you want. There's algorithms and all sorts of things, but just to answer your question, look, a lot of people don't have the time or inclination to learn a very complex platform. IB's customer service also is not the best if you are in some of those countries, so it does dissuade certain people from that. Okay, question from George. If we invest the proceeds of the sale of our properties, what percentage of tax do we have to pay on the income received? Okay, George, are you just trying to interpret that? So are you saying if you invest the you sell your property and then you invest the proceeds in shares, what percentage of tax do we have to pay on the income received? It will depend on your jurisdiction that you live in, as well as any franking credits. So jurisdiction, by that I mean, does the country you live in have a double taxation agreement with Australia or not? If it does, like like Singapore, United States, UK, then the non-resident marginal tax rate is 15%. If you're in a country like Hong Kong or Dubai, where there is no DTA back to Australia, then it's 30%. However, if there are franking credits attached to the dividends when they're paid to you, then that franking credit's worth 30%, and also your tax applicable is 30%, and those two net off. Just to give it on a quick tax 101 on what a franking credit is, let's say, for example, BHP make $1 billion profit. They will cut a check to the ATO for $300 million by way of company tax. That leaves $700 million left over to pass on to shareholders by way of a dividend. If they can't really tax that same pool of money twice, because obviously they've already, BHP's paid tax on your behalf. That's why they paid the $300 million. So you essentially get a 30% tax credit, which both residents and non-residents can get access to. So George, to answer your question, with a properly constructed portfolio, you could keep your tax liability quite low to negative if possible. Okay, question from Lisa. Do you see variance in the property markets across the US? More room in some states, across though. Do you see variance in the property markets across states? More room in some states than others to see falls? Yes, definitely, Lisa. I mean, to me, those markets that had the highest and the most rapid rises tend to be the ones that come down the quickest, and also those markets that probably built and fostered with investors as opposed to owner-occupiers, they'll be the ones that probably feel it the most as well too. Your traditional suburbs with your mum and dad owner-occupiers with a stable job and income, those sort of sectors won't have too much. Certainly suburbs that have a high percentage of renters, they will certainly feel it as well too. Okay, so on to the next one from Julio. Would you please clarify about the last topic, non-residential address? We just did not get that. So Julio, are you talking about with respect to CommSec? With CommSec, we're just saying that a lot of people, to get around the compliance regime with CommSec, that has put an Australian address on their account to keep it going. And what this means is your account is essentially classified as a Australian resident investing account. What should occur is you need to put a foreign address on that, so then they know that you're a non-taxed resident, and they then that, by having the account set up correctly, will then notify the share registry that you are a non-resident, and any applicable non-resident withholding tax is deducted automatically. Okay, question from Mez. Are first-time buyers who are non-resident expats eligible for stamp duty relief on purchase of a property? Mez, I don't think they are. Look, we don't deal with a lot in that area, to be honest with you, but I suspect no. But certainly do your homework. I would, every time I've looked at the first home buyer details in the past, it's always you need to be a resident in that state in order to qualify. Question from John. Sorry if it was answered earlier. I joined a little late. What's the capital gain situation for Aussie expats buying shares now? We're likely to return home in 12 months. John, yeah, you can still buy shares that are essentially, not taxable by the ATO. You do not accrue a capital gains tax liability. When you do come back to the country and you tick that box to say you're a resident returning, you essentially have two options. You can sell down the portfolio, crystallise all the gains tax-free, or you can continue to run that portfolio, and from the growth from the date that you return to that country onwards, you'll continue to, so you return back to Australia, you'll continue to accrue capital gains tax. So from that point of view, it's, not too cumbersome and still certainly appealing. Okay, another question here from Julio. Is it safe to wire USD out of an Aussie bank account for building initial deposit for a house? Sorry, is it safe to wire US dollars out into Australian bank accounts for building initial deposit for a house? Two parts to that question there, Julio. First thing is yes, there's no problems at all about sending money back to Australia. Australian bank accounts up to a balance of $250,000 government guaranteed. So for each account holder, you can get access to $250,000 of government guarantee. You couldn't have two investment accounts, also two savings accounts. Only one of those accounts would qualify for the $250 minimum. You do need to be warned though that based on your behaviours and actions under the domicile test from a tax residency point of view, if you are starting to accrue large amounts of cash in the bank account, the ATO may try and take that behaviour to try and turn around and make an argument that you are a resident for tax purposes because you do not have that money invested, or there's something occurring with it, and a foreign investor, which is what you are as an expat, would generally not accrue large amounts of cash in an Australian bank account without doing something with it. So just be careful on that side there. Question from Khalid. Been living in Dubai for over 3 years, 3 Australian financial years, an investor, ComSec, never done a tax return. Implications? Yeah, look, you might want to, the best homework you can do is you should have received paperwork every time a dividend notice came out from a share registry to say that a dividend's been paid to your bank account. At that point, you should be looking for any sort of comment if the shares aren't fully franked to say that non-resident withholding tax has been deducted. You didn't give us that much details whether the shares were purchased, before you moved to Dubai. Like if you bought the shares in Australia and didn't do deemed disposal before you left, then there's a very real chance that you're still accruing capital gains tax because you didn't separate the tax status of those shares before you left the country as well too. So as you can see, when you are dancing across two different jurisdictions and two different tax residency status, when that changes, your assets do change as well too. And we've come across a lot of people who, bought a number of shares while they're living in Australia. They moved overseas, didn't realise about deemed disposal, and in their mind, they were sitting there, especially through the bull market, thinking this is great, we're accruing all these gains tax-free, when in actual fact, they did have quite a large tax bill to pay when they sold those shares. Okay, Alessandra has just come back saying she's 28. So Alessandra had the question in relation to, was it the UK pension? Yeah, look, so Alessandra, essentially, it's a long way away. You can't really do anything with it until 55. So it's up to you. If you do intend to stay in the UK indefinitely and you see a future there, then maybe, certainly accrue wealth in your UK pension. But if you don't feel like UK is a long place for you to stay there, it's a long time for you to wait to be able to access your funds. Question from Sheena. I have a rental in Sydney, never been my main residence, so the June 20th main resident law would not apply to me. If you leave the property to your children when you pass away, what are the tax ramifications for the children? Look, in Australia we don't have estate taxes, we have something worse. It's called capital gains tax. So capital gains tax is death tax by stealth. So if you were to die and you're passing that property to your children, essentially there is the capital gains liability that you've accrued up until that point, which will need to be settled by your estate. Question here from Bernard. If I'm a non-resident, non-tax resident, do I still need to update the W8 BEN to reflect that I'm a tax resident of another country? Originally, I've been put Australia in the W8 BEN. Look, just to explain to everyone what a W8 BEN form is. A W8 BEN form is a form that you need to complete if you are investing in US domiciled investments, but you are not a resident. So I'm pretty sure it's a W9 that US residents have to complete. W8 BENs are the ones that you have to complete if you are a foreign resident investing back in Australia. Investing back in the United States. You said if I'm on, do I still need to update the W8 BEN to reflect that I'm a tax resident of another country? But yes, you do, because essentially what they will do is they will need to update their records that your new country of residence is not Australia, but is, X, Y, Z. Normally what will happen is it can be sometimes triggered by a change of address on the account when you do change that domicile. So in our experience, yes, you do need to update the W8 BEN forms there, Bernard. Question from Stephen. Most talk seems to focus on expats not wanting to be classed as residents. We do want to maintain our residency. We only pay tax in AU, nowhere else, though we spend little time in AU. Does that help us maintain tax residency? We're in Mexico and are caught up in the property capital gains tax issue. Look, Stephen, probably the issue you've got there is, it sounds like you spend, so you spend little time in Australia, but you want to be classified as an Australian tax resident. You can certainly make that election. If you do make that election that you're an Australian tax resident, then all worldwide income is assessable for tax by the ATO. Obviously, DTAs will be taken into account, but certainly if you are obviously classified as a tax resident, then you are still able to claim and maintain the main residence exemption, but you need to run the numbers on the other side to make sure that's worth your while. Question here from Rob. Thanks, Brett. I understand how the government raises funds for stimulus. How could they recoup that in the future? It is being so large that I can only imagine taxes may change. Do you think anything else could change for expats like the residence exemption? Look, brilliant question, Rob, and it's being hotly debated yesterday and today. People, a lot of commentators are saying that what we're going through right now is the catalyst we need to totally revisit the whole taxation system in Australia. And there were a number of recommendations that were provided to the government over the last couple of years as part of a tax review, and obviously at the time too hard, put on the filing tray, but now what we're looking at talking about is a total review of the whole taxation-based system. Yes, Josh Frydenberg and Scott Morrison, not my two biggest friends right now with respect to the MRE, they have said we're not going to increase GST. But if we follow the recommendations that were put to Canberra a number of years ago, what we would see is a total change in the way that taxes are structured, and we go down the route of getting rid of stamp duty, increasing GST, reducing the thresholds, and completely reviewing it. So certainly, to answer your question, Rob, there is going to be wide-ranging changes that come out of this. I was just talking to clients yesterday, and virtually, part of our discussion was how do they reinvigorate the market after this, or the economy. And look, we could see things like in the US, they built the Hoover Dam, not because they needed the dam, but they needed an infrastructure project to provide jobs. And we could see that coming out of not just Australia, but all other countries, big infrastructure projects that have always been talked about to get that going. And there could be tax implications of that as well too. It's, look, to me, the whole tax debate is going to change over the coming 2 years. There's not many more rules that the government can change that affect Australian expats, which is good. But I'll never say never, because they've found some pretty crafty ways. But yeah, certainly from a Australian residents point of view, look for wide sweeping changes in the next 2 years. For non-residents, probably not so much. Question from Greg. Your question response to Ali for HMRC was interesting. How would it apply to an Indian Provident Fund, superannuation, that becomes available from 58? Greg, you've got me there. not many people do, but I'm not a, you know, I'm aware of the Indian Provident Funds, but I'm not exactly sure how they work. Essentially, UK is the only like-for-like pension that the ATO views on as a, you know, an apple-on-apple comparison. If you look at the Hong Kong Provident Funds, UAE end of service benefits, you know, all of those different jurisdictions, because your earnings and your growth aren't preserved, then more than likely you'll be taxed on that accordingly if you are to redeem that at the wrong particular day and wrong particular time in that tax year with respect to your tax residency. We've seen it time and time again. That's happened with pilots coming out of Emirates, and you need to be very careful. You know, what we help pilots navigate that space in terms of when do you redeem, when do you move back to Australia. Hong Kong is the same, Singapore is the same as well too. So, you know, without knowing a lot about the Indian Provident Funds, if they are like, you know, the other Provident Funds in the Asia and Middle East region, then yeah, pretty much you need to tread carefully with that one as well too. Okay, question from Greg regarding your answer to the UK pension versus super question. Any reason you don't recommend putting it into an ISA in the UK and then making tax deductible contributions to super when you return to Australia? Yeah, look, I mean, the ISAs, you know, are very tax effective as a UK resident, Greg. You know, so I've got no problems at all with that. Any savings is good, you know, savings in my book. When it comes to making tax deductible contributions to super when you return to Australia, the only way you can make a tax deductible contribution is making a concessional contribution, which is before tax. And unless you have an investment property that is earning positive cash flow, there is no real reason to go down the route of contributing as a concessional contribution and claiming a tax deduction. As a non-concessional, which is after-tax money, that's virtually, you know, post getting paid your salary, money can go into super as a non-concessional contribution, which you can put $100,000 a year in, but you don't actually get taxed on the way in for that as well. So if you put money in as concessional, you get taxed at a rate of 15%. If you put money in as a non-concessional, you don't get taxed on the way in. Question from Philip, wondering why I can't see the questions asked by others. We could see the questions last time. Okay, Philip, not sure why that is. What we'll do is we'll pretty much, you know, we'll try and provide as much information in the, actually what you might want to do is where it says questions there, you might be able to click the down arrow and it might expand it up. So just give that a try. Question from Chris. I'm an Aussie expat living in London, have leased my Melbourne home out to tenants. Early next year, I would have been away from Australia for 6 years, and I'm aware that I will lose my capital gains tax exemption, so I intend to move back to Australia, evict my tenants and move back into the home before then. If the 6-month ban on evictions were extended by the Australian government, would I lose my capital gains tax exemption on my home? Look, if you move back to Australia and you don't sell it, then you don't lose it until you move back in and then you sell it. If you were to sell it either as the property as an investment property and or as a non-resident, then you'll only get a partial main residence exemption. Just to give everyone a bit of clarity too on the whole chronology of the MRE, you know, yes, it's a 6-year rule, but the key consideration is if you've been overseas for 10 years and then go back to Australia and live in it, and then sell it in that first year or two of living in it, you do not get the whole thing capital gains tax free because you've been overseas for 10 years. Yes, you get the 6-year main residence exemption, but there's 4 years that you don't get. So it's not as simple as saying that 40% of the gain will be taxable, but all we're saying it's a bit, you know, there's quite a complicated calculation that goes behind it. But just be aware that if you have been overseas for longer than 6 years and your view is to move back into that property and sell it capital gains tax free, then you might be able to do it. So on your question, Chris, you know, if you do go beyond the 6-year mark and then you move back into it, then there'll be a pro-ratering amount. You know, if it's 7 years, then you get, you know, capital gains tax free for 6, and you'll have to pay the capital gains tax for one of those years. Okay, question from Sharon. G'day, Sharon. Question about Dubai. Have you heard of anyone successfully applying for an Australian firm to be a qualifying scheme for the DIFC so they can have, they don't have to contribute to dues? Great question, Sharon, because obviously as our firm is registered in the DIFC, we're actually in the thick of this right now. Just to explain to everyone, in the Gulf, we normally have what's called an inter-service gratuity, where for every year of service you accrue a payment. And what was occurring was companies were going bust. They weren't provisioning for that payment, and if you accrued 10 years worth of end of service, you may have lost that. So in the Dubai International Financial Centre, where we're based, what we've done is implemented the employee workplace scheme, which is like an Australian super scheme, where for every year of service up to 5 years, 5.83% of your salary has to get paid by the employer into this account on your behalf. Doesn't sit on the employer's balance sheet, it actually sits with Zurich and Mercer, who are the providers of the scheme. At first outset, there's only one provider. We haven't actually heard of many, Sharon, in terms of being qualifying as an alternate scheme. We know there's a lot of people who are trying to get them through, but given COVID-19, I think that's all been put on the back burner. We've started to make inquiries in terms of finding an option and those sort of things, because to us that would save two pieces of the movement from a transfer point of view anyway. So no one's been there yet, but we were working on it before everything blew up with respect to our schedules. We do intend to revisit that down the track, because obviously there's a lot of similarities and commonalities between the dues platform and Super as well. So watch that space. I know, Sharon, you've got my email, so feel free to reach out to me if you have any further questions. Question from Victoria here. Reflecting on your previous question, if you're not sure where you'll end up living in retirement, or perhaps one will swing between countries, how should you manage Super versus UK pensions? Look, very good question, Victoria. Sometimes you might want to take a foot in both camp if you are considering Super versus pensions. The hardest thing you always have, and Mr. Murphy always raises his head, is when it comes time to go one or the other. I guarantee the currency is not going to be in your favour, the markets won't be in your favour, so you won't have had that benefit of building something up and then repatriating it too. To me, as we get closer to whatever that date may be with respect to retirement, it will become more apparent as to where you want to go. In saying that, we've had cases where clients, after 18 years, were ready to move back to Australia, started repatriating capital, and at the 11th hour they decided they're not coming back. We had to move everything back again. So change is inevitable. Change is a constant with expats. If you can hedge your bets, definitely. I mean, the fact that you can't pull your super out until you reach preservation age, and the fact that you can't pull your UK pension out until you're 55 sort of means you're sort of stuck anyway. But once you get to that point of being able to move one or the other, by then obviously at age 55, you should have a clear idea of where that's going to be. Question from Tony. Have an investment property in Australia, been living overseas for 4 years and have not done a tax return in Oz. Oops. Best advice on how to catch up on the tax return. Tony, you'll see an email on that on the screen there, info@atlaswealth.com. Send me an email. We've got a number of tax partners we work with who they do a lot of work in the expat space, and always happy to put you in touch with one of those guys or girls. Question from Philip. Hi Brett, you've indicated Oz stock market and property prices heading south. Where do you see upside? At the moment, not a lot of places, Philip. To me, it'd be short-term pain across the board. You don't get an economic contraction like we do, and no one's sort of unscathed. Obviously, a lot of debate as to whether to go into gold. The thing with gold is everything's priced in at the moment. So, you may be entering gold at the end of the party in terms of before the party begins. So that's always a risk. To me, if you are a nervous investor, you're always better off sitting on the sidelines. There's no compunction, there's no reason, there's no gun to your head to put money in. Sometimes a lot of people relax, they get the benefit of investing with hindsight. So they're happy to leave some returns on the table just to get that peace of mind and know that the market's kicking on. So certainly from that point of view, you'd have to say that, in the short term, and I'm talking the next 3 to 6 months, little upside, more downside risk, but at the same token, opportunity in that 6 to 12 to 18 month mark on the recovery side, more so with shares than property. As I discussed before, property will take longer to turn because a lot of the cogs in the wheel are broken at the moment with respect to migration, access to capital, and so on. Question from Alejandro: as an Australian expat without property or any other income streams in Australia, how would franked dividends be beneficial? Look, only if you own shares in Australia and we're receiving dividend income, Alejandro. So if you don't have that, then yeah, you don't get access to the franking credits. Question from Ross: when do you see the oil price recovering? I'm actually surprised I didn't get oil price questions early, Ross, so thanks for asking this one. Look, oil's a mess, pardon the pun. Right now, and I was joking about this with a client on a call earlier today, talking about how, where can we park 1,000 barrels of oil because it's a great arbitrage opportunity at the moment. The issue with oil at the moment is you've had this perfect storm of obviously the global economy grinding to a halt. People aren't driving, planes aren't flying, trucks aren't driving. Any high users of any sort of oil or lubricant isn't working at the moment. So you'll have a natural build-up of supply. Then you've combined with obviously the fight between the Saudis and the Russians. Certainly they've had their come to Jesus moment and they start to, coming back on the same page, but the damage has been done. The problem you got right now is you have a glut of oil. The big risk is it's not so easy just to go up to an oil field and cap it and turn it off, because damage can be done and it can be incredibly expensive. So at the moment it's cheaper to pull oil out, but the problem they've got is where do they put it? Talking to a client the other day who's involved in leasing of crude carriers, so that's the ULCCs and the VLCCs. There is not one available anywhere in the world. Many years ago, certainly would have been about 2015, 2016, when there was a glut of crude carriers that came on the market. You could have actually rented one of these things for $10,000 a day. These days, you're going to pay 10 times that price, and you are not going to see any opportunity to be able to park. Refiners are virtually using these things as floating refineries in terms of storage. So right now, oil, until we see a pickup in the economy and a pickup in demand, I don't think oil is going to go anywhere right now. What the pricing things we saw, or the pricing discrepancies we saw this week, are more to do with the expiry of the futures contract, at the end of month futures contract. So I wouldn't look at what happened earlier this week as an indication as to what's going on. That's why if you look at the numbers in the last couple of days, it is starting to come back up again. So I won't bore you on with the way derivatives contracts works, but yeah, long story short, there's always that flux between the contracted price and the physical price. But yeah, coming back to your answer, until we see the economy doesn't have to start turning, but the general consensus that the economy is open for business, that's what we need to kick things along again. Question from Alessandro: with the rule of being a resident for tax purposes in Australia, who does this apply? I've been in Wales since September 2016. Look, Alessandro, essentially, you need to go through and if you go to the ATO's website and just look at or you can go to our website as well, which is on the screen, type in qualifying as a non-resident, and essentially there's 4 tests to confirm whether you're a resident or a non-resident for tax purposes. The first test is the resides test, which is pretty simple. Where do you live? The second test is the domicile test, and this is what catches most expats out. The domicile test is not only just where you live, but what behaviours and what ties do you have to either that country or back to Australia. In my case, I'll speak from experience. So when we set up the office here in Dubai, myself and my wife and my kids, we all moved to Dubai. We cut ties with Australia, and now we have a lease contract in our name. We have utility bills in our name, phone bills. This is our new domicile. So where it can get convoluted is when you might have families that are split across 2 countries. or if you don't do things correctly, then that can create complications as well too. So, really you have to go through those tests. The third test is the 183-day test. You need to be out of the country for more than 6 months of the year. And the last test is the Commonwealth Super Test, which only applies to public servants and diplomats. Okay, next question from Giles. Hi Brett, what are your total setup and ongoing fees as a percentage to set up and manage low-cost ETFs, and what differences do you provide from compliant platforms like Saxo Trader, i.e. low-cost ETFs like Vanguard, VGB, VAS? Okay. Look, in answer to your question, Giles, it will depend on your funds under management that you invest with us. So there's two ways of looking at it. Our asset management fee is no more than 1%, and it tiers down as the balance increases. We also charge a financial planning fee, which is $137.50 Australian per month per person on the account. And essentially what that is there is it's a retainer fee for us to provide ongoing advice and access to our clients. Platforms will charge a percentage fee based anywhere between sort of 0.2 and 0.4%, or depending on, once again, the size of your portfolio. As a general rule, unless you have a small portfolio, we don't do ETF-only portfolios. And the reason for that is the outweighted bias of Australian banks on the Australian index. Certainly in the US, we're happy to buy ETFs. UK, Europe, we haven't got a problem buying ETFs. We do quite a lot of ETFs overseas. In Australia, banks make up 38% of the index. And as a comparison, in the US, it's only 15%. So if you bought an Australian ETF, you're betting that 40% of your portfolio, you're on the wagon hitched to the bank and finance sector. So to us, it's not prudent as a investment metric in terms of obtaining a fully diversified portfolio. And we use a combination of direct equities, weighted balances, and ETFs to conduct that as well. But more than happy to take that conversation up. If you want to have a chat face to face and via Zoom, and run through any questions you might have. Okay, question from Christopher. Answer: final lodgement complete. It was about the overseas notification for people with HEX debt, not a cash grab for easy 10K, unemployed and could be in final debt. Okay, gotcha. So he's done his final lodgement. It was about the overseas notification for people with HEX. Okay, so yeah, with HEX, for those who aren't aware, as of 2017, if you do have a HEX help or TSL debt in Australia, you have to every year lodge a report through the MyGov platform or through your accountant declaring your overseas income. And if you do have a HEX debt, depending on how high your overseas income is, they will ask you to make a repayment as a percentage of your salary, no different to if you're back in Australia. Question from Adele. We had new tenants move into our Sydney apartment in mid-March, so just weeks before the shutdown. They've asked for a rental reduction. Oh, that's such bad luck, Adele. They asked for a rental reduction due to loss of earnings as they have their own business. The property manager, Ray White, had not helped with any guidance. We offered a deferment, but they said this was unreasonable and we should reduce the rent, but they shouldn't have to pay it back. What is your advice on how to navigate this situation? Is there any guidance from the government? Great question, Adele. We've had a number of clients have a similar sort of question. There seems to be a belief amongst tenants that they don't have to pay back their rent if they are deferred or reduced. And right now, we're in the process of writing up quite a large article for our website breaking down all the different states. It's our understanding, and once again, we're not obviously registered property people, but it's our understanding that you may be able to recoup money from their bond, but until we've done a full analysis, and bearing in mind there's a lot of changes going on, so it's taken us a while to build. I don't want to commit to an answer, I'm afraid, but just keep it on our website because we will have some more information coming out in the next week on what's going on there. But yeah, that's terrible luck there. I'm sorry to hear that, Adele. Question from Christy. I'm about due to refinance my mortgage on my interest-only investment property in July. Given the current environment, do you think I should try and postpone or delay this? that property was at 95% LVR before COVID hit. Have you heard of anything about these sorts of circumstances? Christy, what I will say, I haven't heard anything at the moment. We do have clients who have mortgages going through, but all I will say is banks are run by risk committees, and all depending on how this plays out, the bank's demand and appetite for risk may change. It may change with respect to investment properties. It may change with respect to expats. Who knows? These guys and girls are always changing their mind in terms of what they're willing to look at and won't look at. You know, I normally say it's not a bad idea to have a chat now just to see whether it's worthwhile or to hang on. If you want to hit us up at info@atlaswealth.com, I'll put you in touch with one of our guys who's a brilliant mortgage broker who is a former expat himself and has been able to work magic with a lot of our clients. To be honest with you, the mortgage space can change a lot in the next 2 months. So what may be the case now may not be the case later on. So certainly, you know, reach out, and more than happy to put you in touch with someone who definitely knows what they're talking about. Question from Tristan. If you're repatriating to Australia and you own a home overseas, what valuation information do you need to set a baseline for capital gains tax? Does capital gains calculate from your repatriation date? Also, Christian, you're referring to obviously accrual of CGT overseas. Yeah, virtually it's the day that you come back. Usually the ATO gives you 6 months to transfer any assets back in the country that you can. Obviously you can't move a house. So essentially it'll be the date of repatriation, the day that you become a resident for tax purposes, and then obviously any capital gains that you accrue by virtue of holding that property will be susceptible for capital gains tax from there. Question from Christina. I'm on a US green, excuse me, I'm on a green card lottery visa in the US at the moment, and I know after the 5 years I can apply for citizenship. Really any benefits to doing this? Ultimately, I want to purchase property in both Australia and the US. Look, it's a good question. Obviously, Christina, it's a big jump to go from green card to citizenship. From a tax point of view, it really depends on what your intentions are long term. If you see yourself never leaving the United States, there are smaller benefits of being a citizen than a green card holder. However, with both green card and the US, you are susceptible to what's called the Hart Tax Act, which is the 8-year rule. So you need to be careful and just do some research into that, because the deeper your ties into the US framework, it is more difficult to pull yourself out of that as you come out. If you were to become a citizen and then you decided to move back to Australia, then as an Australian resident, US citizen, you will still need to do US tax returns from Australia. You will still need to declare your assets in Australia, and if you do have super in Australia, that will be accessible as well too. So, you know, we don't like to get involved in the decision process of going from green card to citizenship, but be warned, you can hand your green card back when you do move back to Australia, but you can't. It's about a $3,500 exercise to try and relinquish your citizenship, and even then it's not an easy process. Okay, question from Kathy. Thank you, Brett, for meeting with me my questions personally. I'm glad, Kathy. I appreciate your expertise. In the last few years, it has become more difficult to borrow money for buying a home in Australia and working overseas. Can you see this changing? Probably not, Kathy, and I can only see it getting worse. So the way that the Australian banks work is they, as I said before, they work off risk. You know, when they're in the business of lending money out, but they're always making sure that that money going out is going to a market that is not as risky, or at least risk as possible, so they can get their money back. When we saw the whole forgery scandal coming out with Chinese investors buying off the plan properties out of Melbourne, that has said, you know, no to, you know, all non-residents. I don't see it ever getting back to, I guess, the good old days. At the moment, the way the banks are working, at first they'll look at your currency and see whether you're a gold or a silver tier currency, apply any haircuts, apply any local tax rules. I often find that things get better and easier when it's the good times, and they're happy to sort of let the reins off a bit. Obviously what we're going through right now and what is on the horizon for the banks for the next 5 years, I can't see it improving. In saying that, you know, we've had people getting loans through. So if you do have problems, just get in contact and I'll put you in touch with our guy because, yeah, he's doing a great job and he's the guy that talks to the banks every day. He knows who has appetite for what type of loans and is certainly a great resource for our clients. Question from Abby. So far after July 1st, if sell a property in Australia as non-resident, will need to pay full capital gains tax from the date it was acquired, ? Spot on, Abby. If you bought a principal place of residence back in, say, 2010, moved overseas in 2012, and you were to sell that, in 3 years' time, then you will be paying capital gains tax at the non-resident marginal tax rate all the way back to 2010. Question from Christina. Should I have been doing Australian tax returns while living in the US as a resident for the past 3 years? I was honestly very clueless about the process. What can you tell us about paying off HECS debt while living in the US? Christina, I'll answer that in 2 parts. Strictly speaking, you should be doing a tax return every year to the ATO that you're saying you've earned no Australian income. That's the strict letter of the law. Some accountants say that, look, you don't need to go down that route. You just do a final lodgement. You just do a, hey, ATO, I'm moving overseas indefinitely. This is the last you'll hear from me. When you get HECS debt involved, you do need to do a lodgement every year. So from the 2017 financial year, you need to tell the ATO what your worldwide income is, and you need to declare that to them, and then they will, based on the repayment threshold, they will then essentially tell you how much you owe them. You can go on a repayment schedule if that amount is too large and you can't afford it as a lump sum, but you do need to be telling them. There are penalties of $3,600 per annum if you don't do that. So, a question from Gary. As an Aussie expat in the UAE considering a future return to Australia, would VWRL be a better option or VAS from a tax perspective? Look, good question. I mean, as long as, and I'm pretty sure both, I know VAS is Australian domiciled, VWRL I think is domiciled as well. From a tax perspective, anything that is tradable on the Australian share market is classified as non-taxable Australian property. So whether it's ANZ, BHP, IOO, IVV, VAS, VAP, that's the Vanguard Australian Property Index, VAF, Vanguard Australian Finance, Vanguard Australian Fixed Income. Anything that's traded as an equity on the Australian market does not accrue capital gains tax as it's classified as a non-taxable Australian property. So, when it comes to what you're actually specifically buying, doesn't matter as long as both are currently trading on the market and both carry that same classification. Question from Georges. Thank you. All great advice. We need to speak to you and your team. Fantastic. We'd love to speak to you. I said, head to our website at atlaswealth.com. There's a contact section there. Fill out your details and we'd love to have a chat. Question from Brendan. ING share investing accounts and IG don't seem to be able to change address to USA. Any experience with these platforms? I can speak from professional experience. The ANZ share investing platform, which moved to CMC, is probably the most unmitigated disaster when it comes to compliant handling of clients' accounts. I won't go into too much detail. I don't want to be super slander, but as far as we know, there are no more discount platforms that allow non-resident investors. The only way you can go through and invest in an investment portfolio is through someone like ourselves who have agreements with other providers that don't have the same rules. We obviously qualify with those providers because we have quite a stringent KYC, which is know your client, and anti-money laundering and counter-terrorism finance requirement when we go through identifying clients, which allows our partners concerns regarding non-resident investors. But as far as the discount brokers are concerned, they're not the biggest fans of non-residents right now, and we can't see that changing. Question from Gemma. If you've been out of the country for more than 6 years, what's the period you need to be living in your property and re-established as an Aussie resident before you avoid the biggest sensitivity issues upon sale? Look, at least 6, ideally 12 months, and also that's on the predication that you have only been seized for less than 6 years. If it's been longer, you would not avoid capital gains tax, you'll reduce it, but there still will be an element to pay there. Question from Giles. Hi Brett, sorry reposting my name. Great seminar, thanks. What are your total, okay, yep, so we answered that one. Question here from Anthony. Are funds in an offset account with an Australian bank account also government guaranteed? That is a brilliant question, Anthony, and you've got me. So it doesn't happen often, but I was actually looking at this yesterday, and I will include it in the email that goes out with a copy of the recording. So APRA, in terms of the government guarantee, they outline what classifies as an account holder that is applicable for this. I honestly do not know whether offset accounts are applicable. If it's account, I'll need to go through that. So I'm going to be a politician. I'm going to take that question on notice, and I will answer it in the email. I just need to go back and look at that, those definitions, those legal definitions of who is applicable and what type of accounts are applicable as well too. Question for Bernard. If I'm a non-tax resident, do I still need to update WFN? Oh, yep, I've actually answered that one. Question from Christina. What is the limit of money I can be gifted, transferred from an Aussie bank account before I am taxed? It's approximately $90,000. Should I do this in stages? Okay, so Christina, are you referring to going from, say, your mother to yourself, Australian bank account to Australian bank account? If that's the case, there is no gift tax in Australia. If it's going from a Australian bank account to an overseas account, it will depend on your jurisdiction. I know in the US they do not tax on estates or gifts below a certain amount, but you will still need to declare it as part of your FBAR reporting if you keep that money in Australia as well too. Question from Stephen. Does the ATO tend to want to declare expats AE residents rather than non? That's the impression we get. Look, they would love all expats, especially those in a low tax jurisdiction like the UAE, to be declared as residents because then they could apply obviously the very high Australian marginal tax rates. Even the US, their marginal tax rates aren't as high as what they are here. So certainly from our point of view, we believe that in a perfect world, they would love everyone to be a resident for tax purposes, but thankfully not. Question from Georges. Apart from your tax declaration and complying to non-resident tax rules, are there specific notifications to government that you are a non-resident, non-tax resident, removal of electoral roll, etc.? Look, yeah, good question, Georges. It really depends on, we always talk about the weight of evidence, and it's a matter of fact. So what that means is if you are closing bank accounts, closing off your Australian mobile numbers, removing yourself from the electoral roll, and then virtually pick up your whole family moving overseas, your actions are almost your declaration. And in that tax year, you do a final lodgement to tell the ATO that you've left the country, and this is your last Australian sourced income. That's good practice, and should be highly encouraged. As I said before, you can do future tax returns, which are just virtually nil, to say that you're not earning Australian income as well. It really depends on the account you're working with and how, I guess, compliant you want to be. But certainly, we always say that more is better. But there is no box that you can tick on the ATO portal to say non-resident. Question from Michael. You said a property left to children in a will is subject to CGT. When I wrote my will, I was informed that there was no tax included on any CGT on my estate. Please clarify. Yeah, great question, Michael. If that place is your principal place of residence, then the beneficiary of that property receives your main residence exemption. If that property is an investment property, and that was the question before, then there is tax payable. So if that's your former PPR or current PPR, and that passes on to your children, then yeah, that's correct. There's no tax payable on that one there. Question from Giles. The Australian government guarantees bank credit unions up to 200 grand. Actually, it's 250 for personal investors in the event of the bank folds and where the government possibly takes funds. Note this happened in Cyprus, if you remember. Yep, I certainly do. Is this 200K guaranteed per account, or if it instance you have several savings accounts under the same bank, is this 200K covered per account? It's 200K per bank. So if you've got, and it's just to clarify, it's 250,000, not 200,000. So what it means, if you've got $1 million, you need to set up bank accounts at 4 banks and spread that money across if you really want to take the route of protecting your money. Question from Osama. What would be the case of having an investment property but declaring to bank it's owner occupied? Oh, okay. I'm not going. That's a rabbit hole. I won't climb down. Yeah, I probably can't answer the one there, Osama. Happy to take any questions via our email if need be. But yeah, that's, you know, the bank will tell you one thing officially and another thing unofficially, and that's about as far as I'll take that one. Okay, question from Raylene. Brett, you have done an excellent job. Thank you very much. I'm a career educator, head of school here in the USA. I'd give you an A+. That's the first A+ I've probably got from a teacher in my life, so I'll take that. I need to get back to my job, aka online learning management. Well done. Look, Raylene, first of all, to all the teachers out there, you guys and girls are doing a brilliant job. Now, I know, as I said before, my wife and daughters are stuck back in Australia, so with schools closed in Dubai, they're doing online learning back in Australia with their school in Dubai. And, you know, teachers have got my utmost respect, as well as medical staff as well, dealing with COVID-19 at the moment. Your job from a teaching point of view has gone from teaching from one to many, and your tools were virtually your intellectual property in your brain. Now you've had to document that, and now you're almost teaching one-to-one. So I know we've got a large number of teachers as clients, and you know their hours have gone from 6:30 to 10:30 every day, and most of them are working 6 days a week. So certainly well done, and thank you for what you're doing, because you know, obviously kids are starting to adjust what's going on in the new world. And you know, to me, education, whether it's in person or by distance, still keeps a sense of normality for our kids. So thank you very much for everything you've been doing. Question from Stephanie. I'm living in Sweden. What is the tax situation if I have an inheritance from Australia that is a mix of my parents' primary home, shares and cash? What's the most tax-effective way to receive an inheritance? Okay, so just break it up there for a second. So obviously I won't go into the Swedish tax situation, because you need to talk to a Swedish tax consultant with respect to that. With respect to the Australian side, with their primary home, you have 2 years from inheriting that property to be able to sell that property and utilise your parents' main residence exemption. That is the tax-free period. If you are to sell the property just after that 2-year period, then you will not get access to the MRE, and there could be quite a high tax bill there. So on that side, that'll be there. With the shares, most times shares will pass either by way of cash, like they'll sell the shares down. Any tax that is payable will be met by the estate, and you know, obviously the cash passed to yourself. If there is a, you know, I've never seen this before, but if there is an in-specie transfer of shares, for example, you receive a BHP share from your nana or your parents or whoever it may be, obviously you inherit those shares and your cost base starts at the date of you inheriting those shares. As a non-resident, you don't accrue capital gains tax from that date on, but there will be a tax liability that your estate will have to pay on any capital gains tax that those shares have accrued up until the date of death. Question from Bernard. Sorry, double posted the same question. What I really to ask was, as a non-Australian tax resident, will there be any capital gains implications if I sold my US stock as a non-Australian tax resident, but the W8BM form still states Australian? Okay, so on your W8BM form that you filled when you first bought these shares, obviously you were Australian resident, that you notified the Australian US registry that you're an Australian resident. You've obviously since moved and now you're a non-resident. From an Australian point of view, W8BM forms are IRS related, and they're not related to the ATO. When it comes to the only time that as a non-resident there will be tax implications is with respect to estate planning tax, which can get up to 35%. So Bernard, if you were holding Google and Amazon shares and you passed away, then as they are US domiciled shares, the US will more than likely, as soon as they're notified that your account is becoming an estate account, there will be a 30 to 35% estate tax applied to those holdings. Question from Joe Poon. Would like to know if I need to pay capital gains tax on the sale of my residential property in Hong Kong after I move back to live in Australia. What is the capital gains tax rate? Joe, definitely will need to pay tax. The question is the size of the gain based on a dollar amount. It is a marginal tax rate, so the size of the gain will dictate how many percent you need to pay. A question from Alejandro. It is common in Dubai to receive end of service payments extremely late. What would the implications be in terms of taxation if I receive a large payment after having returned to Australia and becoming excuse me, get a glass of water here. If I become a resident for tax purposes, look, Alejandro, you're exactly right. Those end of service gratuities can take a while to pay. With our clients, we just ask them not to go back to Australia. You know, is probably the most simplest way. Go on a holiday, do something else, because it is a very complicated conversation that you need to have with the ATO in trying to explain why that's been paid late. They don't really care how the wheels of commerce work in the UAE, but you know, from their point of view, actions speak louder than words, and they see money hit your account as an Australian tax resident, then you could be susceptible to that tax. Question from Georges. I was told that if I was to make a contribution to super from the earnings of my rental, that I would no longer be considered a non-resident for tax purposes and would have to declare all of my UAE income. Yeah, look, yeah. As soon as I saw UAE on that, Georges, yeah, there is a whole industry in the Middle East built on trying to discourage Australian expat from contributing to super because, surprise, surprise, they want you to contribute to their 10-year insurance or investment bond in the Isle of Man. It's advice, and I put that word in inverted commas, built on fear. Just to clarify everything, super is agnostic to tax residency. So what that means is whether you're a resident or non-tax resident, it does not matter. The same tax rules apply to super, whether you're in you know, Brisbane or Dubai. So yes, you can make a contribution to super if you do use your rental income from that. If you make it as a pre-tax contribution, you can actually claim a tax deduction. Whether you do that will depend on whether your property is positively geared or not, or you can make a contribution as a non-concessional contribution, which does not get taxed. So, you know, always best to talk to someone who is A, holds an Australian license, and B, holds a local license, and both at the same time. That way you can always ensure that in the UAE you always get compliant advice because, yeah, a lot of these people don't hold licenses at all, and yeah, it really pisses me off. Question from Stephanie. We just sold our house in Melbourne. We've been overseas since 2010, so we expect to be up for 4 years capital gains tax. Okay, that's right, yep. So is that calculated from the valuation date, valuation of the date 6 years residency expired to the sale gain, or is it pro rata, across 10 years? Stephanie, in a very brief way of answering it, it's pro rata across 10 years, but it's not a pure 40% will be taxable, 60% is non-taxable. There are, you know, there's, I guess, what's the best way to describe it? There's a calculation that goes behind it that, you know, changes that number slightly, not greatly, but slightly. But generally speaking, yes, it is prorated. Question from Victoria, very helpful, thank you, great. Julio, thank you, Brett, for your time tonight. In your eyes, what is the minimum amount to kick off a small portfolio? I guess there's two ways to answer that. You know, if ComSec and all the online platforms allowed non-residents, you know, I'd say $10,000. You can buy a very simple ETF that gets you on the board. As those low-cost alternatives have gone away, I know from our point of view, you know, we talk to clients and we say we need 50, and that's because we go down the route of mixing direct equities and ETFs. And the reason for that is in order to be able to get sufficient diversification. But even then, we're not really comfortable, doing a diversified portfolio with direct equities below 100. So we run what we call an ETF portfolio for our low balances until our client's balance gets to 100, and then at that point we move them across into a direct equity portfolio. So if you are able to find a platform, Leo, you can look at 10,000, but more than likely it's going to have to be a bit more than that. Question from Gemma. I've been in the US on a green card for 10 years. I've not applied for citizenship. As I understand it, being on a green card in the US for over 7 years makes me liable for the Hart Tax Act. Is that correct? Spot on, Gemma. You are liable as long as you qualify based on the means test. And this is where I like to have my colleague James Ridley, because he knows his numbers off by heart. But from memory, it is 2 qualifications. It's either 165,000 US dollars taxable income over the previous 1 or 2 years, and or $2 million worth of assets puts you into that bracket. So don't quote me on those numbers. Go to our website at thiswealth.com. Under the blog, look under Hart Tax Act. You can type a search and you'll see the actual numbers there. But if you are below both of those categories, then you are not susceptible for the Hart Tax Act. But if you are above, then yes, you need to crunch those numbers, and it can be a little bit expensive. Question from Lynn. If you have worked overseas and go holidaying for, say, for 2 years, but intend to go back to Australia to live, retire, would you be classed as a resident or non-resident? Look, good question, Lynn. And to be honest with you, my answer is it doesn't really matter, because if you are holidaying for 2 years, you're not earning income. So whether you're a resident or non-resident, there's no tax applicable on that, any salary. The caveat will always be if you do have assets back in Australia that are earning income, e.g. property and or shares, then you may want to be classified as one or the other to suit your tax benefit. Obviously, if it's investment property, then you might want to be classified as a resident, because then you get access to the 50% capital gains discount as well too. So yeah, look, it's horses for courses. We've had clients do both. So question from Abby. If we move back to Australia next year and have an LLC company in the United States, what would be the situation of our company for tax purposes in Australia? Look, it'd be taxed at the overseas company tax rate, Abby, so it's quite a simple one. Khalid says, I'm doing monthly voluntary payments for my HEX, but didn't lodge anything with the ATO for over 3 years now. Will they still question about the non-lodgement? Always recommend you get on top of that and just get up front. A good accountant can often get on the phone and argue the case to try and defer or do the right thing. It may turn out that you've actually been overpaying, but in the ATO's eyes, as you haven't been declaring, they have no way of taking you at your word. So you really need to talk to an accountant to get that all squared away. Question from Kathy. Extremely insightful and helpful. Thank you. Webinar's excellent. Cheers. Thanks, Kathy. Question from Lynn. If your main residence was demolished and a new home built, say 4 years later, when would capital gains be calculated from, if or when you sold it? Look, Lynn, that is a really, I won't answer that question online because there's a lot of moving parts to that, and it may be seen as personal advice. So yeah, feel free to hit me up offline, and we can talk about that. Question from Simon. G'day, Simon. Is there a maximum number of APRA accounts you can have? No, there's not. Record so far is 15. So we've had clients that have get quite, inventive, and they've been banking with banks they never even heard of, but there is none. As long as it's deemed as a ADI, Australian Deposit Taking Deposit Institution, and it's on a list. So what I'll do in our follow-up email that goes out, I'll actually provide a list of where you can see which banks qualify for that. Question from Melanie. I bought a house in Sydney in 2005 before coming to the UAE. If I sell the house and immediately purchased another, would I still be subject to capital gains? Alternatively, what tax am I subject to if I go back and live in the house for a year? Okay, so I'm assuming, Melanie, this house would be a principal place of residence. Essentially, if you sold that, it doesn't matter whether you sell and buy another place. In the US, they had those rules where they get capital gains rollover relief. That rule doesn't exist in Australia. what it virtually means is anytime you dispose of an asset, the applicable tax is payable. Certainly if your property was a former principal place of residence and you sold that before 30 June, then you would get 6 years from the day that you left Australia, and then any gap difference. So you bought the property in 2005. Let's say, for example, you moved overseas in 2006. So that means 2006 to 2012, and then is tax-free, and then 2012 to 2020 you pay tax. If you were to sell that after 30 June, then you would be paying capital gains tax all the way back to 2005. So certainly buying another property wouldn't fix the problem. Any disposal of an asset is a capital gains tax event. Sorry, you say here, so what tax am I subject to if I go back and live in the house for a year? As I said, it'll be prorated. Virtually if you're overseas for 15 years or 12 years, you get, let's say for example 12, then half of that growth is taxable and half isn't taxable because you do get that 6-year benefit. Question from Stephen, just to clarify earlier answer, do you have a right to declare ourselves AU tax residents if all of our tax is paid in AU? To be clear, we are better off as AU tax residents, and if so, does this mean we can escape property capital gains tax for expats? Yes, Stephen, you can, claim as an Australian tax resident. There's not a problem at all with that. We've got clients who have done that. Those who have quite large property portfolios, it's in their best interest to be Australian tax residents because then they get access to the 50% capital gains discount on investment properties that non-residents don't get. So it really is horses for courses when it comes to running your numbers, but yeah, certainly, you do have a right to be able to claim that. Question from Loic, we have a property in Australia and renting it out, owned it for over 10 years. If we live in Paris, we live in Paris, if we return to Australia and continue to rent it out as usual, if after some time we decide to sell. So Loic, for the period that you're away, you will continue to accrue capital gains tax at the non-resident marginal tax rate, and then you move back to Australia and continue to rent it out, you will still accrue capital gains tax liability at the Australian resident marginal tax rate, but you'll also get access to the 50% capital gains discount. So for the period you're away, you get charged the full rate, which kicks in at 32.5 cents in the first dollar, and then when you're back, you'll pay the Australian marginal tax rate, which is dictated based on your income, combined with the 50% capital gains tax discount. Question from Tristan. Hi Brett, thanks for another awesome webinar. With the USA and now South Africa taxing UAE income, especially with the COVID situation and massive government expenditure, and obviously knowing you don't have a crystal ball, what are your thoughts on the government in Australia considering trying to tax expat income? To be honest with you, Tristan, look, I don't like the chances of pulling it off, and the reason, and it's probably the best thing for expats, is the fact that Australia is so small. In the US and Eritrea are the only two countries in the world that have a global taxation system based on citizenship, not on jurisdiction. The US has the ability through trade sanctions and trade negotiations to, I call it bully, foreign governments into agreeing to sign up to what they call their FATCA legislation, which virtually means that if you're a US citizen living in Australia, the ATO will pass all of your data across to the IRS, and that makes sure that when you do your US returns that you're telling the truth. I doubt the Australian government has the firepower or there'll be the resources to be able to pull off a global taxation-based system with respect to that. Yes, the Common Reporting Standard does help them, with their data, but when it comes to the ability to put through legislation, and especially with respect to what's on their plate at the moment and what will be on their plate in the coming years, I'll never say never. They've done crazy things before, but yeah, I think it might be a bit difficult to pull off. But yeah, if they really want to do it, they'll do it. But to me, I can't see the US systems. To give you a bit of history, the US has been taxing global citizens since the late 1800s, and the reason they brought in that was because people were absconding during the Civil War, and that's the reason that legislation's been in. That hasn't just recently come in, that's been in there for well over 100 years. The South African situation, to me, look, whether it works or not, I'm not sure. I really don't know. South Africa would be in a very similar boat to Australia in terms of being able to pull it off. I'm just not sure how compliant it will be. Time will tell, but I certainly hope that it doesn't happen with Australian expats anyway. Question from Jake Demus. G'day, Jake. Currently unemployed in the US by a US employer on an E3. I plan to be here for at least 18 months. If I return to Australia working for the same employer who will allow me to work from Australia, they're still employed on US conditions, will the ATO consider me as an Australian resident once I'm in the country for more than 180 days? I plan to keep paying US state and federal taxes. Yeah, look, I probably can't get into personal advice, Jake, but I will say that any income earned in Australia is assessable for tax. So that's probably about as far as I want to go without providing personal advice. But yeah, it's if you're deemed an Australian resident, then it's no different to someone who's never travelled overseas working for a company overseas online, for example. So when it comes to the delivery of those services. A question from Christina, slightly unrelated. Is there a limit to how many citizenships you can have? I have an Aussie, I have an EU, Spanish passport, an expired Ecuadorian passport, which was thinking about renewing, and on a US green card. Wow. You've got the quadrilla, possible citizenship in future. I don't think there's a limit, but I think you've always got to consider any tax implications it might have. We've got clients in 30 countries, and not a week goes by that someone's making tweaks and changes in the background. So to me, it's a cool brag factor to have citizenship of 4 countries, but you just need to make sure that your taxing rights and tax agreements between all those countries are copacetic, because it could complicate things. But from what I understand, there's not an issue with regards to how many, but you do make an election where you are from a tax residency point of view. Question from Simon, if we can't set up a new APRA account due to not being able to get home, can we transfer to a parent's account, and will this affect their taxation government benefits? Yes, you can transfer it, Simon, and yes, it will affect their benefits if they are means tested. So obviously they need to declare those assets at the moment. There's a lot of people on benefits in Australia who are currently redeclaring their investments to the Centrelink, because obviously with the fall in asset prices, their benefits go up. But certainly if you do move that to your parents' account, then they may be subject to not penalties, but reduced benefits anyway. Okay, question from Alessandra. What is capital gains tax? It sounds complicated with all the questions you've had already. I've heard the term yet find it confusing. Look, a capital gain, Alessandra, is when you buy something for $1 and it goes to $2. That's a gain in your capital. And then all depending on where you are, what country, what you're buying, there may be tax payable on that gain. So the best way to describe my scenario before, you paid $1 for something, it's now worth $2, you've made $1 worth of gain. If the capital gains tax rate is, say, 20%, then of that $1, you must pay 20 cents to the tax authority, leaving you with 80 cents left over. So your cost basis is the price you paid, the capital gains sale event is the price you sell it for, and the difference between the two is either a gain or a loss. If it's a gain, you need to work out what the applicable rate is there. Question from Stephen regarding super. I thought that I was prevented from contributing to my SMSF as an expat. True or false? Okay, great point, Stephen. I'm glad you brought that up. So when I said before, super is agnostic to tax residency, that is this super scheme in general. When it comes to self-managed super funds have their own rule, and there's a number of rules which cause a self-managed super fund to either be complying or not. One of those main rules is the central management and control. Generally speaking, we don't recommend any clients run self-managed super funds, because you can be accused of rubber stamping to get around the central management and control. Central management and control is the ultimate hierarchy or ability to be able to hire and fire and make macro decisions on your account. So you can't appoint a financial planner or an accountant to be a trustee or to control that account, because you can still hire and fire them. It's that hiring and firing, if you're overseas, that ability is what brings undone the central management and control. The question that Steve's asking there regarding contributions, if you were to contribute to a self-managed super fund, it would be a breach of the active members test. And if that breach were to occur, then you could potentially lose 46% of the balance of your account. So yeah, I'm glad you brought that up, Steve. It's not something that a lot of people ask about, but it's a good question. Question from Melanie. If I go back to Australia and reside there and sell my property in Abu Dhabi a year later for less than I purchased, do I still pay capital gains tax? It'll all depend on the currency too, Melanie. So your purchase price can be higher than the sale price, but if the currency goes in your favour, then technically speaking, that may be a consideration as well too. So just be careful of that, because that does catch a lot of people out. Currency is included in those calculations. Question from Abby. Thank you for your answers. Great. Gemma Pollard, thanks. Brendan, I'm living in the US and currently have money in USA shares and ETFs, but looking to move back home in the next few months. Should I be looking at disposing these before I am considered an Australian resident for tax implications or capital gains implications? Look, Brendan, it really depends on the gains you're sitting on, and also to how those liabilities look. Some people dispose to set the slate clean. Others, it's actually not that big an issue because the taxing ability of overseas assets doesn't start until when you become an Australian resident. So, some people are happy to wear that risk. It really is just a horses for courses type scenario. Question from Stephen. For your information, it's not that AU has a citizenship limit, it can be other countries. Okay, so this goes back to the question before regarding can you have too many citizenships? You're saying that the UK has a limit of 3 pre-Brexit, now they've relaxed it. So fantastic. Love data mining these webinar groups because someone always has a good answer when it's outside of our scope. Christina, I love the way you explain things, very clear and no jargon. Thank you, Brett. My pleasure, Christina. Our job is to improve everyone's financial literacy and help everyone with that. So to me, any help that we can obviously provide is very important from our point of view. So we'll just go there. Alessandra, thank you for answering my questions and a great webinar. First time tuning in. Great, Alessandra. Hopefully it's not the last. So I'm glad to hear there. And guys, that is all the questions. So unless anyone's got any questions there, we've been running for 2 hours, 19 minutes. So it's been a good one tonight again. But just to run through here, if everyone does have any questions, we try and put as much information up on our website as possible, as quickly as possible. So, please go to atlaswealth.com. If you do have any questions, you can either email us at info@atlaswealth.com, or you can go to our website and submit a contact request. We've also got a number of social media channels which we find very useful for communicating with expats. We're on Facebook, LinkedIn, which is not on there. I need to put that on there. Twitter and Instagram. These things are changing so quickly. Quite often we find the quickest and the easiest way we can disseminate information to expats in any country is actually using social media. So by all means, have a look. If you're not on social media, consider it. Believe it or not, my father, 72 years old, jumped on the other day for the first time. So hell has frozen over. But as he said, wants to know what's going on in a more concise manner. I had a bit of a laugh at that. He's going to be flooded with memes about COVID. But anyway, so by all means, follow us on those channels. If you have any questions, certainly reach out to us. By the looks of it, the way things are going, we'll probably be doing these once a month. So I can see us doing one about a similar time next month as well. No doubt we'll have even more data to talk about and more sort of evidence as to what's occurring. And we look forward to being of assistance to you guys. So I'll call it quits for the evening and look forward to talking to everyone at a later date. Thanks, guys. Take care.